Welcome, and thanks for tuning into KBRA podcasts. We cover topical research discussion, industry commentary, and more. As we continue to expand globally, KBRA Podcast is a go-to source for timely briefings directly from our knowledgeable team members. In this episode of KBRA's Structured Finance Outlook series, Brian Ford, Senior Director and Head of KBRA's Structured Finance Research, leads the discussion on the 2021 outlook for the RMBS sector. He's joined by Jack Kahan, a Senior Managing Director and Head of our Global RMBS Group. This episode features a review of key RMBS market and performance themes, as well as 2021 forecasts. Stay tuned to learn more.
Hello, everyone, and thank you for joining the Structured Finance podcast series, where we'll be discussing KBRA's outlook for the ABS, CMBS, RMBS, and CLO markets in 2021. Today, we will be discussing how the residential mortgage market has held up so far this year amid the pandemic, as well as what our expectations for credit fundamentals and new issue supply is in the year ahead. My name is Brian Ford, and I head up Structured Finance Research at KBRA. With me today is Jack Kahan, who heads up the Residential Mortgage Ratings Group. Jack, thanks for joining.
Thanks, Brian.
All right, so let's jump right into it. How has Resi credit held up during the pandemic, and what are your expectations for next year?
Sure. Thanks, Brian. So, look, mortgages had a bit of a tough time during 2020, as most credit obligations did. The availability of forbearance options for borrowers through COVID-19 was, I think, very helpful for borrowers, but also led to a significant increase in, uptake of those forbearance programs and through that delinquency. So, we saw in prime collateral, for instance, we saw, approximately 6.5% of loans that were affected by COVID. By affected by COVID, I mean loans that eventually went delinquent and or deferred. So combining those together, we saw a peak level of about 6.5%. We're actually not too far off from that. Delinquencies for prime collateral is down to approximately 4%, but that includes about 2.5%, which has been modified or deferred. In more non-prime credit, so this would be non-QM transactions, that number was significantly higher. I mean, total overall affected collateral, we had tracked up to about 25% on average across non-QM deals. This is using our KBRA RMBS credit indices. And that leaves about 16% of that collateral in non-QM that's still delinquent at some level, about 11% of which is 90 plus delinquent or seriously delinquent. And then we also track CRT indices as well, which aren't too different at this point from what I was describing for prime collateral, as those are prime credits. In the low LTV, it was a little bit lower at around 6% total affected. Much of that's still delinquent, as the CARES Act provided for a longer term of forbearance for those borrowers. And in high LTV, it reached up to about 7.5%. So those are just starting now to get into the later stages of cleanup through deferral and other relief methods.
So that's interesting. So what are some of the ways you see credit getting better or worse in the year ahead?
Yeah, so that's probably going to be pretty event driven. In terms of getting better, I think there's a fairly solid story there. We had a peak of delinquencies for mortgage borrowers that happened around May and June. And that was obviously, just a few months after lockdowns within the US started. And so that was the impetus for a lot of the strain on borrowers in terms of their ability to pay, or at least their expectations around ability to pay. And so since that time, we have, for the most part, been coming down from peak levels of delinquencies or peak levels of forbearance. At first, it was fairly quick. The rate of decline is slowing a bit at this point, but there's a clear trajectory for borrowers to be worked out of delinquency. And a lot of that has to do with those deferrals I was talking about. Some borrowers are reinstating or repaying, which means of their own volition, they're coming back current. And those likely are borrowers who either were less affected or had some cash that they had in reserve that maybe they didn't want to tap initially, not knowing how long of an issue this was going to be. And deferrals, I think, are pretty good option for borrowers who can continue to make payments under their current loan payment program, meaning their current amortization schedule, just without paying back any payments missed under forbearance. If they can get to that point, that's a pretty nice program for them to be on because they don't have to pay back those payments until the end of the loan term in a balloon payment, either through refinance or payoff of the home. So I think the case for things getting better is pretty good. And also, one thing that really hasn't happened is we haven't seen, at least yet, any major decrease in home prices. And so a lot of the borrowers in PLS and in CRT, excluding the high LTV portion, have been very low LTV. And so there's been a lot of equity for borrowers, at least at origination. And home prices, pretty much for any vintage, have continued to go up. That's almost been exacerbated to some extent by the crisis instead of muted by the crisis. And so the story for things getting better, I think, is pretty good. One outstanding question for me is these borrowers that I was talking about who have been offered deferral, will they redefault? Will there be, some expectation that they would continue to perform differently than borrowers who were current all throughout COVID? Right now, we seem to think so. We make our assumptions that, yes, those deferred borrowers will perform differently and worse than a borrower who was making payments all through COVID. But that remains to be seen. I think over the next 6 to 12 months, we might get some more information on that. They may prove to be very different than your more typical mod. In terms of things getting worse, I would say, look, we are still in the middle, and if not the middle, we are at some point still in this pandemic. And as everyone knows, it is a very hard to predict issue. And so we've had promising news for vaccines that have come out, but at the same time, we're experiencing new highs for COVID cases. And so any type of additional lockdowns or stay-at-home orders or business closures is going to have an effect on borrowers. I think now the silver lining to all that is that we have a little bit more of a playbook to know how that might affect borrowers for the next time around. So that's sort of the get worse case, is that there are increasing stay-at-home orders or business closures that can affect self-employed borrowers, which were the hardest hit segment in the first place.
So Jack, that's interesting. So you brought up home prices. What are your expectations for home prices over the next year in terms of, do you believe it to be a strong market, or will there be some softening in the near term?
Yeah, thanks, Brian. It is interesting. We started off thinking about this crisis that there would be actually, some level of home price declines across the nation. And that's how we had been stressing transactions that we've rated. And, the thought process there obviously is that, we expected there would be a decline in demand as many borrowers were being laid off, and maybe expecting, or at least having no expectation of what could happen through this crisis, and so would be a little bit more cautious with purchase decisions. That certainly didn't happen. In fact, the opposite happened. One thing, obviously, we had with a decline in the economy was also a decline in interest rates, and so that led to declining mortgage rates, which actually has caused demand to increase as far as we can tell. And on the supply side, we still haven't seen the growth in supply that's necessary to counteract that demand. And so we've seen actually faster increases in home prices over the last couple of months than we've seen in the last few years on an annualized basis. And so that story, if you think about the supply-demand imbalance, it's hard to look at it and see, okay, what's going to cause this to change in the near term? You can either have supply increase meaningfully, but where are we going to get that supply from? Home builders have been trying to go after that, but in a lot of the localities that you need supply to offset the demand, there is difficulty in building new homes or creating new home stock, either through permitting or local land use, or even just finding the land available to do it, or to getting contractors and getting the crews together to do it. It's a difficult process, and it takes a long time to build up the infrastructure to get that supply up to where you need it. And on the demand side, like I said, we have record low mortgage rates, and that's not expected to change anytime soon. I would expect through 2021 that we continue to have record low rates. We put out a piece recently describing the difference between primary and secondary spreads, and it actually looks like, at least for the time being, there continues to be some room for mortgage rates to continue to decline, even where interest rates are today. And so that could cause demand to be high for some time. And I've seen other forecasts that leave mortgage rates pretty flat for the next year. So with demand continuing to be high and supply being constrained, it's hard to see how that imbalance changes. One thing that's possibly on the horizon, but again, it's still possibly a few, at least months away, if not, years away, is that unfortunately we do have a large number of borrowers, like I said, that are in serious delinquency. What you can have in those times is if they actually do need to go through foreclosure, you can see liquidations of those properties, and that can help to ease home prices. But even that, as I said, is still some ways away, as we're still currently under foreclosure moratorium. And even once that's lifted, it does take time, and there potentially will be a backlog for those properties to get back on the market. So as it stands right now, it seems that high home prices are here to stay for a while. Now, this is being recorded, so of course somebody can play that back for me when something unforeseen happens in the next 6 months.
So it sounds like the Fed, which is clearly on very accommodative footing, at least throughout 2021 and probably many years after that, has been very supportive of credit fundamentals and home prices. Do you think that this will also be supportive of supply in the year ahead? What are your expectations for new issue in 2021?
Yeah, I definitely do. I mean, these loans that we're talking about that are being originated through a refinance and a purchase boom have to go somewhere. And so the biggest place that will be uptake for that will obviously be Fannie and Freddie. But prior to COVID, the story that we were looking at a lot was that a lot of conforming collateral was being securitized into the prime space. So because of tightening spreads for securitization and some areas of the agency purchase box, which I think issuers would have felt were being priced too high for sale into the GSEs, it made sense to securitize that conforming collateral over into prime. And so, going off of some of the thoughts that I was saying earlier about how it looks like we're on a positive trajectory for some level of recovery here, I think issuance for prime collateral especially is probably the rosiest that we're seeing. So just to put some numbers on it, we saw 2019 close out at about 60 billion in issuance. I think we'll see 2020 a little bit down from that, around 55 billion in total issuance. And by the way, issuance I'm talking about here is RMBS 2.0, prime, non-prime, non-QM, and CRT transactions. And so we saw issuance come down a little bit in 2020, of course, because of COVID. But 2021, in my view, is at least in total going to be, essentially the 2020 we were expecting. So we're expecting upwards of 70 billion in issuance. Like I said, a lot of that's going to be growth in the prime sector, and to some extent growth in the non-prime sector as well. One area that's still a little bit opaque is the CRT sector, because of regulations in that space, and in particular the regulators with Fannie and Freddie still under conservatorship and some jockeying around what's going to happen with that. It seems a little unclear about what the path for CRT issuance is going to be going into 2021. And so we're conservatively expecting a decrease in CRT issuance next year versus this year. But all in all, the increase in prime issuance and non-prime issuance, we think, is going to counteract that, with the largest issuance year in 2021 that we've seen post-crisis. And so we are expecting a large issuance, and a lot of that's going to be driven by that increase in volume from refis and purchase activity.
Cool. Am I right, Jack, in the fact that RMBS is it down in 2020?
Yeah, so it is a little bit down. Yeah.
I guess you did say that. Yeah. Okay. Yeah. I mean, every other part of structured finance is down pretty big. At least what I was looking at when we were doing the compendium back in September was that RMBS was at least flat or only slightly down. So it's definitely held up a lot better.
Yeah, we're down about 10%. The end of the year in 2019 was big for RMBS, and so finishing kind of slow here is not helping.
All right, thanks, Jack. So it sounds like next year might be, a good year for supply. I guess what I'm wondering is there anything that we should be thinking about that might not be in the mainstream? Like, what aren't people thinking about that you think people should be looking at right now?
Yeah, we've been having a lot of conversations with investors recently, and I think for the most part, yeah, everybody is pretty dialed in and focused on the right pieces of information. There's a lot of time being spent right now trying to get a better handle on what it means in different transactions to see delinquencies and how that affects deals. And so, in terms of putting your time and putting your weight into thoughts about RMBS, I think that's time well spent thinking about how the transactions are reacting to delinquencies and how reporting's happening. That's definitely where most of the thought should be placed. And I think a lot of investors and market participants are focused on that. Some of the stuff that's a little bit down the line that, of course, is being put by the wayside right now is somewhat smaller items, at least at this time. But if we didn't have COVID, we'd be having a much larger discussion about the continued move out of conservatorship for Fannie and Freddie or some type of housing reform. We'd certainly be having larger discussions about the removal of the GSE patch, which has been put by the wayside for the most part, at least in terms of overall market participant discussion. I know the CFPB is still actively working on that and thinking about what to do with QM, but that conversation is muted as we all deal with COVID-19. And then, getting more into sort of ticky-tack stuff. One thing I'm thinking about that I haven't really heard much conversation about, and it certainly doesn't need to be front and center right now, but there's a lot of triggers in transactions that relate to loan performance and relate to rep and warranties and repurchases of loans. And particularly in the non-prime space, I think about those transactions which don't have necessarily automatic review triggers, but they have triggers that come up when loans take realized loss. And through deferral, those payments that are deferred end up being taken as realized losses. And at that point, either the controlling holder in many cases or some group of note holders is able to bring a review of a loan. And so I haven't heard much about that being reported out to investors, or if investors are looking to take advantage of those potential for repurchase obligations that are there. And I think if this was a bit more of a quieter period, that would be something we'd be talking about more.
Great, thanks, Jack. And thank you everyone for joining today. You can find all of the outlooks online at KBRA.com. You can download them for free. And thank you very much for joining today.
This concludes our episode. Feel free to continue the conversation on LinkedIn and Twitter at Quirlbond Rating. We would also like to remind you that our research and rating reports are free at KBRA.com. If you have any podcast ideas or would like to share your feedback with us, please email media@kbra.com. We hope to see you next time.